Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is Axel Merk. He is the CIO and founder of Merk Investments. They manage currently over $1 billion in gold and mining investments. Axel, welcome to Wall Street Silver.
Great to be with you guys.
Yeah, it's an absolute pleasure. Axel, we just had the Fed meeting this past week where they raised interest rates again and they're basically confusing the market. What's your take on this, Axel?
Well, the square that, or the circle that needed to be squared was the Federal Reserve has a dovish pivot because they were raising 75 basis points a meeting, and they're signaling they're going to raise only 50 basis points going forward. At the same time, the whole point of raising rates is to quote unquote tighten financial conditions, to make it more difficult to access capital. And so if they were to just have a dovish pivot, well, the markets would be all excited and financial conditions would be easing. And so he had to have several talking points as to why this is not dovish. And that's why he came up with this idea, oh, we're going to be higher for longer. And by the way, now it's all about the destination. We don't know what the destination is, but it may be higher. And then somebody during the press conference didn't have a real-time Bloomberg or something, said, oh, the markets are up, which they weren't, they were down. And so he rattled down his talking points as to how incredibly hawkish they are. But it's really they were dovish because they're going to raise less the next meeting, and the message had to be, we are hawks, we're on top of it. And so it didn't really matter what he said, but that's the context. He had to come across as hawkish.
Well, that's the key thing is they are making these, they've raised now 4 times in a row, 75 basis points each time, which is actually an indication of failure. It shows you how far behind they were behind the curve in terms of catching up to fight inflation, right? So they had to just do these incredible rate hikes. At some point, everyone's thinking this breaks the system and they have to slow down. They can't keep going at this pace, right? Going at 75 basis points per meeting at some point has to slow down. And did you get that sense from the statement that we're there? The next meeting in December is not going to be 75 basis points. It's going to be something less than that?
Almost certainly it's going to be 50 basis points. But let's take what you just said, right? The Fed's actions are aspirational. They would love to keep hiking rates. And Powell said as much. He wants to get to the stage where the federal funds rate is higher than core PCE. That's their measure of inflation. Based on market estimates, be as they are, that's going to happen towards the end of the first quarter. My take of that is in the May meeting, they'll pause. That said, the one mandate of the Fed that's more important than employment, that's more important than inflation, is financial stability. Right? So if and when the wheels are falling off, then they'll pivot. So what does it mean for the wheels to fall off? Well, the Fed doesn't really care when there's trouble in British gilts, doesn't really care when the Swiss borrow a little bit of money at the Fed, but those are the canaries in the coal mine, right? Something is going to get their attention. John Williams, he said, well, as long as core markets are functioning, everything is good. The New York Fed president, right? Core markets, he refers to the reverse repo market, right? If he's waiting for that to fail, good luck, right? Then the world is going to be on fire. And so my view is they'll pull this through if the market lets them. And if the market has a fit, then they'll back off. Now, that fit has to be significant. Equities just falling down won't matter. The economy just tanking doesn't matter. It's really the spreads you have to look for. Swap lines at a big scale if other countries have a huge panic. And that could happen tomorrow, or it might never happen. Nobody knows. The Fed certainly doesn't know either.
Well, at some point, though, there's a limit to how much they can raise and for how long. And I thought that this little meme that's been popular on the internet has been kind of interesting. If they leave rates at above 4% or 5% even, where we might end up in early 2023, the longer they leave rates this high for the 2-year through the 10-year yield, and the more debt, I mean, I saw something from Tavi Costa at Crescat Capital that something like 6 or 7 trillion in debt matures each year and rolls over at these higher rates.
Wow.
At some point, the interest that we're paying on the debt swallows a huge portion of our tax revenue. It's already approaching more than we spend on defense, and could double from here if they leave it there 2 or 3 years. Is there
we don't need to be that academic, right? The whole point of raising rates is to break things.
Yeah,
that's the whole point of it. I mean, we call them financial conditions tightening, but that's what that means. And so we see little things break. At some point, bigger things will break. And that's why historically, when the market is pricing in rate hikes, almost always the Fed stops earlier because stuff starts breaking that gets their attention. And one of the problems is, right, let's assume for a moment, all right, it plays out the way that the Fed would like it to. The Fed is going to hike a few more times. Inflation, because of the year-over-year comparisons aren't so bad, are going to be fine. And so inflation is now going to be only in the 3% range for several months in a row. Economy is going to keep slowing down. Well, then what? There is no assurance whatsoever that inflation has been beaten. Ben Bernanke, who everybody loves in your audience, I understand. One of the things that he wrote in his recent book, and it's very torturous to read it, so I did everybody a favor and I read it, but he pointed out the bare truth that once inflation is high, the problem is that it's not linear anymore, right? If inflation were always at 8%, it would suck, but we could plan for it. But that's not what happens. Inflation is high, then it falls down, it might jump back up, it will rear its ugly head somewhere. And so it is not a strategy to just say, oh, we'll be higher for longer. There's no assurance whatsoever that they'll have beaten inflation. And that's why I mentioned Larry Summers, right? We need a framework and a Fed. And it's not just the Fed, other central banks as well. The only thing they say, oh, sorry, guys, the model was wrong and we were caught off guard. That's not good enough, right? You need a new framework as to how to approach this to gain the confidence in the market that they'll be able to tackle that going forward. There's no sign of that, which means this sort of instability that we have, including the volatility we have in the market, is likely going to persist. Because if there's no strategy, the market gets that and is also just going to gyrate based on the mood of the day at the Fed.
Well, I want to ask one more question about the Fed, and then we're going to shift to talk more about gold, specifically your area of expertise. But we're already sensing. You already said it's pretty much a lock that it's going to be 50 basis points in December. Do you get a sense of where they're going to stop yet, or is it too early to say? Have they given any sort of hints that, hey, they're stopping at 5%, they're stopping at 4.75%? Or
the market, as of the meeting this week, says a little over 5%. I think the timing is more certain than the level. The timing is the early May meeting, and that's just, if you look at the calendar, they say they're focused on core PCE. Well, core PCE comes out with a 4-week lag, and so the February core PCE meeting release is not going to be available for the March meeting, and so that March announcement for February core PCE is going to be crucial. Just based on the base effect on the year-over-year comparison, that number is going to look probably okay, and that's going to give them the excuse to pause then in May. That's the next meeting that comes after that meeting, and so I'm more certain about that timetable, with the caveat, if the wheels start falling off, obviously they'll break earlier. But if the market holds up until then, and when I say the market holds up, there's a big misperception that the Fed cares about the equity market. The Fed cares about the bond market, and so the spreads in the bond market. That's what matters. How junk trades and other things, and there we got some distortions, of course, because a lot of the junk debt is issued in the energy sector, and so the Fed is lulled into believing that things are okay because energy prices are high, and which also means that if and when the wheels do fall off, it's going to be a bigger disaster because it will have creeped through the things that it shouldn't have creeped into. And one of the things Powell said is that, oh, they can always drop rates sharply if they overdo things, and he had a fist in his hand when he said that. Yeah, good luck with that, right? I mean, historically speaking, when they've had to do a U-turn, they had to act not just sharp, but they had to stay down then for an extended period.
What's your definition of when the wheels fall off? What is that? Be like no more junk bond or high yield debt issuance? I think that was it in 2018. The junk bond market basically froze up for 6 weeks, and the Fed pivoted, right?
Yeah, the more academic answer is there are several financial condition indices. There's a Chicago Fed Financial Conditions Index, which takes less the VIX into account. Too many of these indices are just a reflection of S&P volatility. I think that's a bad thing. I like to add up things. So activating swap lines is a very important one for me. There are some swap lines activated to Switzerland at a low scale. That means there is an urgency to get dollars abroad. To me, that's, by the way, if the Fed were to activate swap lines aggressively because of some dire situation abroad, that really gets us back to a reflation environment, will induce a secular dollar bear market, which is good for those currencies, but also obviously presumably then good for gold as well. So a big activation of swap lines is a necessary, not necessarily sufficient condition. And then, yes, the spreads in the bond market, right? The spreads in the bond market as far as junk debt is concerned. One concern I do have in all that, we have seen both in the Bank of England and the ECB that they might just want to have the cake and eat it, meaning they'll continue to hike rates, but think that they can put out the fire. So the Bank of England saying, oh yeah, we'll bail out those pension funds, but we'll hike rates anyway. Or the ECB saying, we'll have quantitative tightening, but we'll buy peripheral debt. That stuff doesn't work, but might delay the pivot. That said, the moment the Fed starts taking these things more seriously, the markets are forward-looking, and gold miners are early to react, and they will start moving once those sort of signs are more apparent.
Central banks, I want to talk about that for a second, because this is an article, a guy who I follow on Twitter, and he has a great Substack. He wrote this recently, I think just today. There's been some mystery big buying, and I think the headline number was almost 400 tons of gold were purchased recently. I'm sure you probably saw those same articles in the past couple of days. Is this central bankers who are buying these things in markets that, I guess China and Russia don't necessarily announce China doesn't announce their numbers. Yes. What's your sense on these huge purchases in gold lately, where it's coming from?
Well, first of all, you got to put up my Twitter feed and tout my own horn here.
Of course.
I'm on Twitter. But yes, I mean, central banks have been buying. Obviously, Putin was buying aggressively ahead of the invasion, right? Mm-hmm. As one of the tools that folks that want to do some mischief around the world have to have a backing, because there's always a way to trade gold. I mean, it's laughable to have these sanctions when you have a commodity that you can smuggle very, very easily. The density of gold, it's one of the key reasons why gold is used. You have so much value in just one of these bars, right? And so yes, I mean, and people and of course you see the US using its muscle more to sanction other countries. So if you're another country, if you have the choice, you want to be less dependent on the U.S. regulatory environment, right? And so those are great incentives to increase your gold holdings. At the same time, we do also see a broad investor interest in gold. Well, part of it is the U.S. Mint and some other mints are hopelessly behind, and on the production side, you guys probably know that even better than I do. But even on the institutional side, we do see that there's a mix. We have some folks that are selling, we see others that are buying. One thing, if I just go back to the markets, gold tends to react early to these things, right? If we have a severe recession because the Fed is higher for longer and they actually can pull this through,
right?
Historically, the risk assets tend to bottom out about halfway, 2/3 through a recession, whereas the price of gold and gold miners tend to recover much, much earlier. So they tend to be a leading indicator in that sort of game.
So Axel, based on everything going on in the world right now, we have a lot of people in our audience who invest in physical silver, physical gold, and also play in the mining companies. Where do you think the best place to be positioned right now? Is it the big producers, the junior producers or the exploration plays? And we're not talking any specific names. We're just talking big macro level. Where would you be right now?
Well, best is of course in the eye of the beholder. It really depends on what you want to get out of it, right? I personally invest in both gold and gold miners, with a focus more on the exploration companies. But as I trust most of your viewers are aware, the more you go down, gold is actually the most quote unquote conservative investment of these. I mean, all of these, of course, have inherent risk, but the explorers tend to be notoriously volatile. The larger miners, less volatile. The big mining companies have their act together, and that's not necessarily a good thing because they are. And the reason I say that is they're producing so much cash, and they have invested so little in new production that they don't have as much leverage to the price of gold as they used to have. So the whole purpose of investing in these gold miners is to get the leverage. Now, that said, and they, in the next 5 years at the very latest, they have to start acquiring other companies because these gold mines will get depleted. And so you can go one level down of investing companies that are potential targets, or in smaller companies. They really use the small exploration companies really do the work for the big ones. And so they might get acquired. And so one of the things we do is we're looking for these sort of companies that have good management teams and are located in a place that might be attractive to the bigger mining companies. So they'll be taken out at a premium, presumably. Now, that said, the mergers that have happened in the industry haven't been at a premium. The market has often not rewarded them. But these small exploration companies, and by the way, one of the reasons the small exploration companies are more volatile is because they do need access to financing. We do a lot at Merck to help institutionalize these assets. But in a hostile market environment, and that's why Fed tightening isn't necessarily good for them, only the best ones of them will have access to financing. And so our approach is to diversify, to actually invest in several of them, because not all of them will make it. As we speak, they are flamboyantly higher, but we've seen days when they have fallen down. So it's a very speculative market. And it's in that sense, when you ask what the best place to be is, I started investing in physical gold in the early 2000s, tried to buy once in a while. Price of gold has a volatility of about the same as the equity markets, although we can have very severe downdrafts. Whereas in the mining sector, if you go downstream, the explorers, you can easily have twice the volatility, right? So it's really that in context. Ultimately, is your long-term view that the Fed can be so tough? If so, you want to stay away from gold and gold mining. If you think the Fed cannot be that tough, I do think it's a very attractive place to be.
Well, I mean, that's where I'm at right now personally, is I think there is a limit to what the Fed can do. They can only raise rates so much, and there's a time limit for how long they can even leave rates that high, just before, I'm just speaking out of my own personal beliefs right now, that I think it's inevitable that they have to bring rates back down.
I mean, one way to think about
gold and silver take off, right?
One way to think about it is that if gold is a brick, a barbaric relic, right? Doesn't generate any dividends. And so if you're rewarded for holding cash, then cash is king. Right. But if not, then real commodities have actually a good chance of performing well relative to cash. And in this quote unquote tightening environment, I mean, many people will say, "Oh, inflation is higher than interest rates are," but markets are forward-looking, and so if you look at forward-looking inflation indicators, which, by the way, nobody knows what inflation will be in 5 or 10 years, but they are measures of the confidence in the general market in the Fed's ability to contain inflation. And so as long as there is confidence in that Fed's ability, and as long as the market believes that hawkish talk, then there's pressure on the price of gold. And so the question is whether we've reached peak hawkishness. And so I'm not even concerned about, well, when is the Fed going to pivot in lowering rates? To me, it's more when will the market perceive that the Fed is easing up? And that happened actually, the most recent FOMC conference, except then Powell said, no, don't read it that way. And for whatever reason, the market actually believes that bluff that Powell has. But to me, we are very, very close to that change in approach.
they've always had this 2% target for inflation. And a lot of people believe that it's not possible to get back down to 2% anymore. If you go back to the late 70s to the early 80s, everyone gives Paul Volcker all this credit for having raised interest rates dramatically and beaten inflation. But what a lot of people forget is we had huge energy projects coming online, the Alaskan pipeline, North Sea oil, Gulf of Mexico offshore oil. We had huge, new, cheap, high quality, affordable energy hit the market during that time period. And a lot of, I'm personally of the belief that was a huge factor in bringing inflation back down. So in this current scenario, where we don't have these huge new energy projects, high quality, cheap energy coming online, a lot of people are questioning whether we can even get inflation back down to 2%,
right,
in the absence of cheap energy. And I don't know if you have any opinion there on whether it's even possible to get back down to 2%.
How many hours do we have? In the interest of time, let me just, since you mentioned Volcker said, for a stable society, you need three things. You need good governance, you need sustainable finances, and price stability. All three of these areas we have been neglecting.
right.
And then on top of that, of course, we have this deglobalization. And so all of that breeds instability, inflationary pressures, and so forth. So all of these create reasons why we should be concerned about inflation. And it's a much broader discussion, right, how that's going to work out in detail. But it is something that I think as investors we should be concerned about. We love to look at the ticker table and this goes up, this goes down. We forget that we had decades after World War II of peace and prosperity. And so we noodle around and talk about the Fed. In the meantime, right, part of the world is burning, and there will be more crises, right? And I don't like investing in gold because the crisis flares up, because usually the market gets used to these things. But all of that means the cost of doing business, to just put it abstractly, is getting to be more expensive. And so those are all drivers as to why inflation is going to be higher. And then, as you pointed out, right, if we don't allow investment in resources, without abundant access to energy, we cannot have a liberal democracy, because we got to suppress a class. And the Europeans are trying to destroy themselves, for example, right? All of that then suggests that people will try to cling to other things. And I do think precious metals will be part of that beneficiary. So when precious metals do well, usually we got plenty of our problems on our hands.
Yeah. Well, Axel, thanks for joining us. We really appreciate it. I've really enjoyed this, and let's do it again in the next 3 months. For the audience, Axel's link to his Twitter account and his company are in the description. So if I suggest giving him a follow on Twitter, and we look forward to talking to you again in the future, sir.
Yeah, let's do it some other time. Great to have spoken with you guys.